Hello everybody, my name is Mark, and in this video I am going to talk about how you can use charts and patterns to decide what you want to invest in, whether you want to go long or short, etc, etc. So without further ado, let's get started. I'm going to start with the most highest flying stock in the whole stock market to date, and that is Amazon. Today is May the 24th, 2017. Market is closed. So let's pull up the chart. Okay. Come on, chart. Okay, here's a chart. Now, first, let's look at the big picture. This is over the last 10 years. You see that Amazon has been going up like gangbusters. So that's what the chart looks like. And you see there's a little dip there and a little dip there. And that would have been in the last 2 or 3 years. So let's look at the last 3 years. And this is the last 3 years. So again, been going up like gangbusters. A dip there, and then up again, a dip there, and then up again. So I guess if Amazon's going to follow suit, it would take another dip. And let's take a look at what its growth was. That would have been from January to January, and that would have been from January to January. So it seems like near January is where the dips are. Let's clear all that out and restart it over. Oop, I hit the wrong button. There we go. Okay, so its last meaningful trend would have been from here to here, and that looks like to be about September, October, maybe near the end of last year to where we're at now. So let's go to 6 months and check that out. All right, again, nothing but bullish. So I guess this is a pretty straightforward stock. I would just buy call options. I would go here and look at some call options here. Maybe go a few months out to May. So maybe I'd go out to September. And it looks like the calls are going for about $1,000. No, I'm sorry, I'm looking at the wrong thing. Wow, calls are expensive, but that's because it's a high flying stock. So I wouldn't just buy straight calls. I would do a debit spread. So I would go to vertical call spread, view the chain, and now we're talking. Okay, now I can get good deals on the calls. So like this call right here, I could, I'm sorry, I'm looking at the wrong one. I would have to look at, let's move it over a little bit. I would be looking at this over here. So the bid is $160. The ask is $380. So I could get that for about $270 a contract. And that would give me the right to buy Amazon at $999 a share. And I would be going short, or no, I'm sorry. Let me, I got to expand. Do I need to expand this out? No, I got that right. So I would be buying a $985 call and selling a $990 call. And so that would give me the right to buy Amazon at $985 a share. Amazon currently is at $980 a share. Sorry about that. My security won't leave me alone. My antivirus. And that would cost me all of $270. So that's what I would do. Okay, so because the chart is so bullish, so that's an easy one. Let's go on to the next one. Let's do Google. That's another nice strong company, huh? Looking at the chart, starting with the big picture, we'll go 10 years, and oh, I got splits on there. Let me get rid of those splits. Okay. So that's the chart. Google has been around for only 3 years. So let's shrink it down to 3-year chart. 3 years chart. Again, a very strong uptrend. It had a flat area for a while, and then it broke out right about there, and it's gone up ever since. So again, this one I would buy calls, and I'll bet you anything they're expensive. But let's take a look. Let's see. It looks like $820 was its last level of support. So first, I always look at the long term, and yep, they're expensive. So let's go in shorter so we can get them cheaper. We'll go 114 days out, and yeah, these options are again not cheap. So I would have to do a spread, vertical call spread, and now we're talking. Now we're talking here. So let's see. Let's look at the $5 spreads, huh? You're going to show me the $5 spreads? Or is there nothing there? Okay. Try this again. Okay, that didn't work. I guess it doesn't do $5 spread. This is an advanced order for the spreads here. So let me, let's go 3 months out. Let's go 86 days. And again, let's look at the call spreads. Okay, these ones are $5 spreads. That's what I'm talking about. Okay, so last price of Google, $954.96. So basically $955. So I would look at probably buying this one right here, the $955 call, selling the $960. The bid is $130. The ask is $390 here. Why is it doing that? I don't know why. There we go. So that means I could get those contracts for $260, possible profit of $240 in the next 86 days. So that's what I would do. I would do a spread, get them for nice and cheap, because I would be buying this one for $3,500 and some change. And I'd be selling this one for $3,300 and some change. Higher strike price means I pocket the difference. I'm sorry, the lower strike price means that I put out a little more, but I could make a profit. That's what the spreads do. So that's what I would do. I would, again, buy calls. Now, let's go to a lesser higher flyer one. Let's go to Boring Stock General Electric. And here is Boring Stock General Electric. Again, let's look at the long term. And over the long term, kind of a slow mover, huh? Now this is that's a year, and that's a year, and that's a year. So this is over 10 years. So let's exit the trends and start over again. And you can see in the last year it's been very flat with a little bit of a downturn there. So if I were to do technical analysis on this, I would be thinking maybe it's going to go down. It looks like, well, let's go to the lesser chart. Let's look at the 1 year chart here. And there's its downturn. And this one, let's see. That's a pattern there. And very flat in those months, but all of the trends, you see it's both of those patterns are slightly pointing downward, so it does have some bearish tendencies here. So for this one, I don't think I would buy puts because it doesn't move fast enough, but let me look here at the put options and see what I can get here. So let's go to, well, first I want to look at the long terms. That's cheap. I like it when the spreads are very small like that. That's only a 20-cent spread. So if I paid $580 for that, then that would make my break even at $26.20. Last price was $27.83. So that's $1.23. $1.23 into 27 is about 4%, right? Somewhere about 4 or 5%. So I think what I might do is I would buy some put options. Sorry about that. I think I would buy put options. They're cheap. They're only $580 for a nice safe in the monies. Maybe I get a bunch of them. Maybe I get 6 or 7 of them, but then I get like maybe 3 or 4 call options, and that would be my hedge. One of my mantras is I never just buy or go long or whatever in anything without some form of a hedge, which is protection. So that's what I would do. I would get several put options, and then I would get a little less number of call options, and that would be my strategy, for the simple reason of these bearish tendencies. Put options are contracts to sell stock at a set price, and this has recent bearish tendencies. So let's exit that, and now let's look at a more fun stock. Let's look at Nugget, an ETF on the gold mining companies. Very volatile, and this is over the last year, and you can see how darn volatile this thing is. Just in the last year, back in right here, it was all the way up to $140, and that would have been 1, 2, 3, 4, 5, 6, 7, 8, 9 months ago. 9 months ago, it was at the $140 level, and now it's all the way down here, right? So you wouldn't want to go long on this, that's for sure. At least not there, but there are some huge upswings. There's an upswing, and there's an upswing, and there's another upswing there, and there's a little upswing, there's a little upswing, there's an upswing, upswing, upswing. So tons of opportunities if you're a bullish investor, but same opportunities for the shorts, downswing, downswing, downswing. So this is a good stock for some short-term trading. Okay, so when I look at short-term trading, I look at its last meaningful breakout, which would have been right there. It was high flying there, and then it came back down, and then right here, right around there is the part that I would look at. Right around there, that part, that big area right there. So starting right there, that's its last meaningful part. Let me clear that out, make it easier to see. So from right about there, let's see, how long is that? April, 2, 3, 4, 5, 6, 7 months. So let's look at the 6 months chart. And this is over the last 6 months. So look at that lovely volatility. That's exactly what you want if you are a short-term trader. So up here, and this would have been about back in February, which is about 3 months ago, it was all the way up to 50 bucks, and then it dropped to 30 bucks, and then it went up to 45 bucks, and then it dropped to the $30 range, and now it's at $35 range, and back here is a $25. So just from here to here, that's a doubling your money opportunity. And from here to here, if you're a short seller, that's not quite doubling your money. It's like 80%. You would almost 80%. So you'd have to use some rules, right? You'd have to use a methodology. So here, what would I do? Well, there's a couple things that I think I could do. One is I could just buy the stock and sell some in-the-money covered calls, and maybe go about a month out. And what was the support at right here? $30. So let's see, what could I get for the $30 if I went in the money on the calls? $30, I could get 600 bucks, which would bring me up to $36 and some change. So that's $100. So here's how this works, ladies and gentlemen. If I bought 100 shares of this ETF right now, I would spend $3,514. Okay. If I sell an in-the-money covered call, I would get somewhere in between $600 and $615. So let's say I get 600 bucks. We'll even be conservative. Okay. That means that because I am selling covered calls, I am giving somebody else the right to buy my 100 shares of Nugget that I just bought at $30. And for that privilege, I'm being compensated the amount of the premium that you see here. So I would get $605 added to my account. So that gives them the right to buy those shares at $30. So $30 plus the money that I get would bring me up to $36, about $36. So I paid $35.14. That means I could make about 80 bucks. So $80 on a $3,500 something investment is about a 2% return in 23 days. That is a wonderful opportunity. And if my money was not tied up in another investment right now, that's exactly what I would do. Because that, when I look at this chart, this 6-month chart, that looks very safe. Now, if I go in closer here, it is true that there is a little dip here, just a little dip, and it does go below, but it does bounce a lot. And so if it did that, I got more money than 3,000 whatever dollars, then I could buy in even more. I could roll out the cover calls. So selling cover calls is one very good strategy I could do on this one. It's not the only one. There are other good strategies. I could do a moving average strategy. So another thing I could do is put in this simple moving average of, let's start with a 5-day, 5 days, and update this. And that's my buy signal. Okay. And then, I don't know why I'm talking about moving average. This video is supposed to be about chart patterns, right? But I would use a moving average strategy as well. And then I'd put in a 25-day moving average. Maybe. And that would be, I would use that as my support for my stops. And maybe I would be good just with these two, right? Since it is been kind of flat in the last little while here, I go to 1 year, and there is a very flat level here, right? So that is kind of a flattish thing. So I think that a moving average strategy would be another good thing to do with this. So I'll go back to the shorter one, and I would use this indicator right now as a buy signal, and you can see it's already above the support, the stop. This blue is a 25-day, and the green is a short term. So let's go to that 10-day there. Yeah, so it did just recently go above the blue. I could even buy right now and just use that blue line as a support. So I would be buying at 35 and maybe set my stop loss at 34. That wouldn't be good though. That wouldn't be good. So I actually, I'd have to wait. If I used a moving average, I'd have to wait until a pullback, because it did just recently go up, and I'd have to wait for it to come back down before I got back in. Because generally, you want to wait till after it drops and then buy. So I would have to wait for something like that to happen. Like right here would have been a perfect time to buy. And then if the blue line is your stop loss, then you would have made about, if you would have bought 100 shares, you'd made about $100. So that's a moving average. But now I want to get rid of these moving averages and look at the charts here. And let's reset the trend lines. And now let's look at pure charts. Okay, so last meaningful breakout was right here. So right there, and so that's a year. So I'm going to shorten it. And there's a couple ways that you can use charts. One way is to use channels. Okay, a channel is when you draw a line at the top and you draw a line at the bottom. And you can see over the last several months, Nugget has traded up here, and it's traded as low as there. And so if you're going to trade in these channels, then what you might do is wait till Nugget gets near the bottom and then buy. And so if we went to a 1 month chart, then we'd want to wait for Nugget to get down there. So we'd want to wait for Nugget to get to the $28 level, and then we would, well, this is good. This is a 6 month chart. This is good. This will help make it easy to see. So we'd want Nugget to wait to get down there, and then maybe set the stop loss down there. And there's a possibility we could make a heck of a lot of money. I mean, if it did keep it up, it could go up to back to here, or maybe even up to this level, and you can make $5 or $10 a share. So channels is one way that you could use charts. Another way that you could use charts is you could make geometric shapes, and I'll show you what I mean. I'll go to the year, and this chart in particular, it would be easier to explain if it was back here, but I don't want to go too far in the past. I want to stay in the present. So let's go back to 6 months, and again, using charts, we have this here, and then we have this here, and then you draw that. So right here is a high of about $50 and some change, and here's a lower high, and here's an even lower high, and then down here is a low and a little bit lower low. And so that's where these triangles come from. So triangles are a shape. It's a visual representation that the stock price is not going up or down at a great pace, but the highs are getting lower. Just happened there. What just happened there? Let me reset this. Okay, sorry about that. My computer glitched. So let's try this again. So oops, forgot to hit the draw line. There we go. So the highs are getting lower, but the lows are staying equal. So that tells me it's a bearish trend, right? The highs are getting lower. So that means that it could break out there. So what I might do is I would wait until these two come together, or I would wait until the price broke up to this part. Oop, lost my triangle there. I would wait till the price went above this range up there, and then I'd either I wouldn't buy put on. Well, actually, let me look at the spreads here. See what I can get for the vertical put spreads. I'm sorry, I'd actually have to, yeah, vertical put spreads. And if I got a debit put spread, let's go further out, 114 days, and we have, it looks like, okay, let me close this out. So the last price was 35.14, and its support is at about 30. So let's look at some of the in the monies here, or near the monies even. So again, let's look up vertical put spreads, and we get, okay, that's not bad. If I did a bear put spread, I could buy contracts. Gives me the right, that's only $1 spread. Maybe I want to go more than $1. Maybe I want to go $2. Alright, that's a little better. Let's see what other kinds of spreads there are on this. Alright, now we're talking. So let's look at the $5 spreads. I like this one right here. This one, I would buy a $35 put, sell a $30 put, and I would be spending $750 and some change, and I would be collecting $480 for a net difference of about $270. That's worth it, and I could make a possible $500 for a difference of $230. So I invest $270 to possibly make $230. That would be worth it. So that's something that I would think of doing on Nugget. So first I draw my little pattern, and then I try to figure out what the best strategy is. So I think this has got a bearish pattern here, because the highs are getting lower and lower and lower, and the lows are getting the same. And maybe I'd wait until the triangle meets together. So triangles is another kind of a pattern that you could trade. So I could go all day with this kind of stuff, just looking at stocks and dreaming up different stuff that you could do. But this is a little taste of technical analysis here, and how to do that. So you could use moving averages, but this video I wanted to show you a little bit on how to draw little charts. Okay, and oops, I didn't mean to do that. And when you're drawing charts, you just connect the dots like that. You come up with the shape, and then you wait for the price to go in outside of those boundaries, and then you can make a proper decision on that. You also look at the direction of your shapes to see where it's going and what it's doing. And again, there's no exact science to this. Of course, you'd have to use stops if you're buying or shorting. You always want to be careful and protect your money. So that's a little taste on how to do charts. And in the middle of the video, I went a little over moving averages because I like moving averages. I think they're good to use. So that's it for this video. Thank you for watching, and I will see you in the next one.